Welcome back to the Williams Real Estate channel. Today we're discussing why I have decided to refinance all my debt to Bank West and fix it for the next 2 years. You heard me right. I have fixed all my loans for 2 years at 5.5%. I consolidated debts from CBA, First Mac, and Liberty. I was getting charged up to 8.5% from Liberty. So consolidated, did a cash out refinance to Bank West and locked in the next 2 years at 5.5%. We'll be discussing this today, and this is by no means financial advice. Talk to your financial planner, advisor, do whatever you got to do, your mortgage broker. But this is my story and this is what I'm doing. So take it with a grain of salt. I use this 18-year land cycle. I came across it. Very thankful I came across it back in 2014, 15 in the recovery post GFC. As at the time when we went through the GFC, I couldn't work out why. At the time, my father in the 2000s leading up to the GFC did very well in his business. He had an oil distribution business. They printed money back in the day, especially in the 80s and 90s and 2000s. Come 2008, the business went broke. And I could never work that out. And then at the time, I couldn't work out how could no one see it coming. Surely there's data or research on the global financial crisis. And I came across the 18-year land cycle, Phil J. Anderson, Akhil Patel, Fred Harrison. There's a number of them that talk to it, research it, get all the books, because this will give you clarity. Or just follow my videos and follow along, because this is moments in time as we go through the current cycle. We are on this blue marker, equivalent point of time, late 2006, a year away before peak market in 2007, before we went through the GFC. Or if we go back to the prior cycle, 1988, year away from peak market, 1989, before we went through the 1990 recession we had to have. In the 1990-91, Paul Keating, famous quote, recession we had to have. I'm sure Jim Chalmers will be repeating, quoting his same quote in the coming years. Or if we go back again to the late 60s, before we went through, or at the time, I wasn't born, but before the markets went through the early 70s land-driven downturn, which almost wiped out Harry Triguboff, Alan Bond, and in the 90s, Trump nearly got wiped out, and in the GFC, Lehman Brothers, and lots of people felt that. So we're due. We're due. We're on the blue marker. 1 year to year and a half from peak market, but come 2028, we're due for the next land-driven downturn, and every second one's a big one. So this time round, I see it being catastrophic, like the early 90s, which was ingrained into the baby boomers' psychology and memory of those times. Ask any baby boomer who was holding property. Interest rates got to 17% in 1989, 1990, prior to the 1991 recession we had to have. So, not saying interest rates are going to get up to 17%, but they're on the way up from here, I believe. As history shows, where we are now in the latest stage, inflation runs high, as credit is created, the land boom is in full swing, speculation is in full swing. People are going crazy just trying to buy anything and everything, especially into Brisbane, Perth, Adelaide, the regions. People are ploughing into Darwin and Townsville. It's even starting to heat up in Melbourne and even parts of Sydney. So now is crucial to get your market selection right, your price point right, your yield right, your type of property right, because even times like these where people even chase commercial, they're chasing high yield. They pay premium peak market off the cap rate. When the market turns, history shows that the likes of commercial real estate can lose 50 to 70% value. High-end real estate, 30 to 40% value. New off the plan, 20, 30, 40% value. There's a rush to affordable in the likes of Sydney, Melbourne, and the affordable stock rises in a time of crisis, as that is where the demand shifts. The RBA will drop rates come 28, 930 later decade once they panic and finally see that we've entered the next downturn. They don't have much of a long-term view of the world. They're only looking at last couple of months and quarters to work out whether to put interest rates up or down. So history shows that rates actually end up going higher to end the cycle. Come 26, 27, I see rates going up. So that's the land market. That's an overall summary of where we sit. And now I'll show you key data points of how I see rates going up from here. Firstly, inflation was trending down in 22, down to mid 25. But as of mid 25, it's starting to trend up and it looks to be set in its course now. As you can see, June 0.9, July 3%, August 3.2, September 3.6, and we just recently got data out today from the ABS, October up to 3.8%. That is the Consumer Price Index, CPI inflation was 3.8% in the 12 months to October 2025, up from 3.6% in the 12 months to September 2025. The RBA looks at the trim mean, and the trim mean is sitting at 3.3, but the CPI is also trending up and is well above their target. Their target is between 2 to 3% or 2.5%, and it's above their target now. So be sure that there's definitely no rate cuts coming in the near term, as inflation is above their target range. And the only way to get inflation down is to raise the cash rate. Now, if we look back in history, in similar moments in time, as you can see, we're here in 2025, inflation started to pick up again. If we look back at a similar point of time, pre-GFC, inflation ran above the target in 2006-7, and then we went through the GFC. And if we go back again to the late 80s, where we are, equivalent point of the cycle, as you can see, inflation picked up in the late 80s. After the mid-cycle slowdown in the early 80s, inflation came down, but then ticked up again in the late 80s, topped out in the late 80s, and then that's when we went through the 1990 recession we had to have in the 90s. And again, if we look back from the 60s, inflation ran high into the early 70s and then ran even higher throughout the 70s. So hopefully you don't go through that. But property is the best hedge against inflation. Sure, you got to manage your budgets, manage your cash flow, manage your cash buffers to ride through it. But inflation is actually good for property investors because it increases the value of the asset and also devalues the debt that you use to buy it. Let that sink in. Inflation is good for property investors, provided you can manage your cash flows and manage the higher rates. So the RBA held at 3.6% in November. The next meeting is on the 9th of December, in the next 2 weeks. And if we look back at history, similar moments in time, 2006, the cash rate went up to the peak market in 2008 before we went through the GFC, where they then panicked and dropped it low again. Trying to find data further back, but the RBA didn't have it on their website. But the cash rate trended up and topped out in 1989, 1990, at 17.5%, the cash rate that was. And then again, we went through the 1990 recession we had to have, where they then again dropped rates very quickly over that period. So I see rates from here going up 7, 8%. Come 26, 27, they'll be peak market. Come 28, something's going to give. It'll probably be the amount of private equity, which is unregulated in the market these days. It's near 50% of market share, and cryptocurrency, which will probably get turned to dust, is probably the two weak points in the economy this time round. Nothing's different. It's the same old story. We're in this final euphoria where people think we're on to the next wave. So buyers beware. And this time round, I'm seeing it being catastrophic for the reason being these three stooges, Albo, Jim Chalmers, and Chris Bowen. Main reason being is their net zero agenda, trying to put coal-fired power plants out of business when they're two-thirds of the energy supply to the grid, and they're trying to move away from that, shut them down. They're planning to have them all shut down come 28 and transition into renewable energy, wind, solar, hydro backed by gas. But we're already seeing it with high energy prices going up, with your power bills, your gas bills. You can obviously feel that, but businesses is where these guys are really going to do damage, because they're already sending the likes of aluminium smelters out of business. They can't make their manufacturing stack up. The likes of BlueScope Steel are saying it's now 3 times more expensive to manufacture the likes of Colorbond Steel, metal framing in Australia. They might as well import it from the US, where it's 3 times cheaper. And even the likes of bars and restaurants and fish and chip shops that need power to generate their business, cooking, providing hospitality to the market. If they can't pass on the high cost of energy and they can't make a profit, they shut the doors, unemployment will go through the roof in the coming years. So this is where it could be really amplified this time round, is by creating an energy crisis, which will ultimately run through the economy and send businesses broke. And if there's a widespread layoffs because businesses are getting wiped out thanks to these blokes, well, that's when you can see unemployment go up, and then the RBA will be forced to stimulate by providing job seeker, job keeper payments, similar to what they did through the COVID recession. That's just quantitative easing. That's just printing money, pumping the economy with new credit, which is inflationary. So that's how I can see inflation kicking off, and then rates will obviously have to go up. We'll go through a stagflation environment. So as a property investor, you can hedge against the tough times ahead. Not here to sugarcoat it. This is reality of the way I see it going. We're going to go through tough times, I believe. But a good way to hedge it is buying affordable real estate, blue collar, working class, nothing sexy, nothing flash, half the intrinsic value, strong yields. You'll hedge against inflation. You just need to make sure you manage your cash flow, because rates will probably go up higher from where they are today. It's not just Australia, it's happening in the US as well. Inflation is again picking up again as we are in the late stages of the cycle. And if we look back at history, the federal funds rate, again, similar moments in time. Before the GFC, rates went higher till they peaked, and then they dropped to very low. They have recently dropped them down again, but that is also inflationary. So that will probably kick off another wave of inflation. Trump's also talking about getting rid of Jerome Powell when his term's up in May 26 and putting someone in that will drop rates so he can stand over the Fed. And history shows in these moments in history where we are in the later stages of the cycle, there's always been a Republican in power going back over 50, 100 years. If you look at the presidents of the US, typical of where we are now, and now we have a property mogul who likes low rates in the White House, who is standing over the Fed and demanding low rates. So you can see what's going to happen. Rates will come down probably early next year. A big wave of inflation will kick up again, and then they'll be having to chase their tail and raise rates higher, which will ultimately end the cycle come 27, 28. And if we look back in history, 2006, 7 rates went up. And again, in the late 80s, the federal funds rate went up, which ended the cycle in the 1990. And again, in the late 60s, this was the land boom, peak market, late 60s, early 70s, land-driven downturn into the early 70s. History is repeating like clockwork. As always, is by no means personal or general advice. Prior to making any investment decision, you should seek independent advice before making a property purchase or acquisition. If you ever need help, shoot us an email. Happy to help navigate through the turbulent times ahead. This is the time where, yes, we are going through this end of cycle, but what it really is a wealth distribution. The people that are prepared will be able to take advantage and prosper, and the people who are not prepared will probably be getting wiped out. So be sure to be prepared, be cashed up, don't be over leveraged, and be ready to take advantage of the great opportunities as they arise, which is all the time, because there's not one property market. As you will see, if you look at my monthly market updates that I run every month and correlate it, long-term trends with the 18-year land cycle framework, you'll see markets are already moving, like Sydney and Melbourne, in early stages of their next bull runs. So they're the markets to be getting into and not getting caught up in all the fuss and chasing all the FOMO and the mainstream herd that are heading into the likes of Brisbane, Perth, Adelaide, and their respective regions, as they'll be sure to be losing their shirt in the coming years. Until next time, thanks for watching.